$10 trillion. It's a number so vast, it ceases to be money. It becomes an abstraction. A gravitational force, pulling talent, resources, and the entire weight of human expectation toward a single, invisible point. In the last 2 years, this is what we have collectively wagered on a new kind of mind. Artificial intelligence. We have seen this kind of faith before, not in dollars, but in zeal. It is the same collective surge that built the pyramids, that launched ships across uncharted oceans, that laid cables across the bottom of the sea. Today, that faith is measured in silicon, and its temples are the stock charts. We see the apostles of this new age. Nvidia, once a humble maker of graphics cards for gamers, has been reborn as a titan, its stock price a vertical line. A heartbeat monitor of our collective fever dream, soaring from $150 to over $900 a share. Microsoft, the quiet giant of Redmond, has poured $60 billion into the invisible architecture of this new world. Google, Amazon, Meta, the entire pantheon of modern gods, all betting their kingdoms on AI. Their prophets, like Nvidia's Jensen Huang, promise nothing short of total revolution in every industry. Sam Altman, the face of this new clergy, speaks of AGI, artificial general intelligence, not as a distant dream, but as an imminent, almost biblical arrival. And investors, gripped by a profound, primal fear, the fear of being left behind, are pouring money in as if tomorrow is already guaranteed. But in the quiet hum of the data centers, beneath the roar of the trading floor, lies a secret, a dissonance. The math doesn't work. We are building the most expensive infrastructure in human history on the assumption that value will eventually appear. Companies are spending hundreds of billions of dollars to erect digital cathedrals, but the pews are nearly empty. The revenue isn't there. The truly scalable, society-changing use cases remain elusive, trapped in the realm of productivity tools and novelty. And the costs? The costs are not just astronomical. They are fundamentally, existentially unsustainable. This is not a new story. It is history's oldest financial echo. We are witnessing the dot-com bubble of the year 2000, except this time the scale is an order of magnitude larger. The ambition, infinitely greater. We are about to watch $10 trillion in perceived value simply vanish. There is a rhythm to human progress, a 4-beat waltz of innovation and delusion. First, a new technology emerges. It is brilliant. It is magical. It whispers of a new future. Second, the promise. The prophets and the promoters declare it will change everything. Not just one industry, but life itself. Third, the mania. Investors, driven by greed and anchored by the fear of missing out, pour in billions. Stock prices detach from reality, floating on pure narrative. Fourth, the reckoning. Reality always hits, and this is the crucial, painful detail. The technology works. The tech is real. The crash doesn't happen because the invention is a fraud. It happens because it cannot possibly deliver on the scale of the promises made at the cost required, in the time frame demanded. The revenue models, so simple on paper, prove impossible in practice. The companies that spent billions, the champions of the new era, quietly go bankrupt. The stocks evaporate. And generations of wealth, built on hope, turn to dust. It happened with the British railway mania in the 1,840 seconds. Fortunes were built on speculative lines to towns that didn't exist. When the bubble burst, it wasn't because trains were a bad idea. It was because you couldn't justify building 10 competing tracks to the same small village. It happened with radio in the 1,920 seconds. RCA's stock soared, promising to wire every home for sound. Then the 1,929 crash revealed the market was saturated, and the profits could never support the valuation. It happened with the dot-coms in 2000. We were promised a new economy. We got pets.com. The internet did change the world, but only after $3 trillion of speculation was wiped out. And the survivors, like Amazon and Google, spent the next decade slowly, painfully building real, profitable businesses. It happened with crypto in 2021. And it is happening right now, in plain sight, with artificial intelligence. The AI crash will not come because the technology is fake. It is, perhaps, the most powerful technology we have ever conjured. The crash will come because the expectations are inflated to the point of absurdity. The spending is so extreme, it is starving the rest of the economy. And the revenue model, The simple act of getting a customer to pay more for the product than it costs to deliver is fundamentally broken. This is the paradox of the AI bubble. It is a revolution we cannot afford. To understand why, you must first understand the spending, not as an abstract number, but as a physical, world-altering mobilization of capital. Let us start with the spending, because the scale of this capital expenditure is almost incomprehensible. Forget, for a moment, the lines of code. Think of the steel, the concrete, the silicon, the power. In 2023, the world spent approximately $200 billion on AI infrastructure. The physical data centers, the chips, the cooling systems. In 2024, that figure climbed to $350 billion. Projections for 2025 exceed $400 billion. That is nearly $1 trillion in 3 years on infrastructure alone. This number does not include the human cost, the billion-dollar salaries for AI engineers. It does not include the acquisitions of startups. It does not include the research. This is just the cost of the foundry, the physical hardware and raw power needed to forge this new intelligence. So, who is spending this money? Or, more accurately, who is receiving it? Let's start with Nvidia. They are not spending. They are the high priests, collecting the offering. Nvidia manufactures the GPUs, the graphics processing units, that have become the one and only crucible for AI. In 2022, Nvidia's data center revenue was $15 billion. In 2023, it was $47 billion. In 2024, it is projected to eclipse $100 billion. That is a 7-fold increase in 2 years. This growth is built almost entirely on AI. Their H100 and H200 chips, pieces of silicon and metal the size of a book, are being sold for $25,000 to $40,000 each. And they are not being bought by the dozen, they are being bought by the tens of thousands. A single AI training cluster, a specialized warehouse of these chips, can cost over $1 billion to assemble. And every major tech company is building multiple clusters. Now, look at the buyers, the ones building these digital temples. Microsoft has spent over $60 billion in the last 2 years. This includes their direct $13 billion investment into OpenAI, but the rest is pure infrastructure. Building the global machine to run AI services. Google has spent approximately $50 billion. They are building their own chips, their TPUs, in a desperate race, while also buying Nvidia's GPUs. Meta has spent over $40 billion chasing its own vision of an intelligent AR future. Amazon, over $30 billion to power its cloud. These are the giants. Together with Nvidia's other customers, Oracle, Tesla, 1,000 smaller cloud providers, they have burned over $300 billion in just the last 24 months. And the spending is not slowing, it is accelerating. It is a financial arms race, fueled by the belief that the winner will own the 21st century. But this brings us to the critical question, the one that hangs over this entire $10 trillion gamble like a guillotine. What are they getting for this money? What is the return on this investment? Because spending $300 billion is only justified if you are making that money back plus a profit. And when you really look at the revenue numbers, you find the terrible, simple truth. The spending is an inferno, and the revenue is a flickering candle. Let us break down this revenue, company by company, piece by piece. Let us follow the money, not to where it is being spent, but to where it is supposed to be coming from. Start with OpenAI, the epicenter of the quake, the company that began this new religion with ChatGPT. As of late 2024, its annual revenue is approximately $3.5 billion. This is up from $1 billion in 2023. Impressive growth, a phenomenal product. But OpenAI is not profitable. This is an understatement. OpenAI is a financial black hole. It is reportedly burning through over $5 billion annually on compute costs alone, the price it must pay Microsoft and others to rent the very infrastructure its partner built for it. The math is simple. $3.5 billion in revenue, over $5 billion in just one of its costs. That is a loss of nearly $2 billion a year, and it is growing. And the market's valuation for this business? $150 billion. Investors are valuing a company that is hemorrhaging billions at 43 times its revenue. This is not business logic. It is a faith-based initiative. But OpenAI is a startup. What about the giants? What about Microsoft, its primary benefactor? Microsoft has skillfully woven AI into almost every product. Copilot in Office, Azure AI Services, Bing, infused with ChatGPT. Surely the revenue is pouring in. But when you look for the numbers, you find fog. Microsoft does not break out its AI-specific revenue. The numbers are murky, bundled into cloud growth and Office subscriptions. Estimates suggest AI adds perhaps $10 to $15 billion annually to Microsoft's top line. This is significant. But remember, Microsoft spent $60 billion to build it. At $10 to $15 billion a year, it will take them 4 to 6 years just to break even on the initial infrastructure investment. 4 to 6 years in an industry where 6 months is a lifetime. And that assumes the revenue holds steady and the costs don't keep rising. Neither is guaranteed. Let's turn to Google. The same story, a different logo. Their AI revenue, again, is hidden, blended into cloud services and its advertising monolith. Estimates suggest a contribution of $15 to $20 billion annually. Their spending, $50 billion. A 3 to 4 year break-even, if you are an optimist. But the real story is more desperate. Google's flagship AI, Gemini, is given away for free. It is a defensive weapon, a multi-billion-dollar shield to protect its core search ad monopoly from ChatGPT. Giving away a product that costs billions of dollars to run is not a revenue model. It is a defensive strategy. It is a company digging a moat with burning cash to avoid losing its kingdom. And Meta? Meta has spent $40 billion on AI and its parallel obsession, Reality Labs. Yes, AI has genuinely improved its core business, ad targeting and content recommendation. But this is an optimization, not a new product. The marginal revenue from better ads is impossible to isolate. Meanwhile, its new consumer-facing AI products like the Meta AI Assistant, minimal revenue. They are, for now, just cost centers. Billions spent so your feed scrolls a little more smoothly. Finally, Amazon. Their AI is in AWS, their cloud service. It is in Alexa. It is in warehouse optimization. AWS AI services might generate 10 to 15 billion. Amazon spending? 30 billion. Again, years to break even. And then there is the ghost of AI's past. Alexa. For a decade, Amazon has tried to make its AI assistant profitable. For a decade, it has failed. Amazon loses billions on Alexa annually. Adding more powerful, more expensive AI to a product that already loses money doesn't fix the underlying problem. It only makes the loss more expensive. Now, let us step back and add up this new economy. The Big Five have spent, in just 2 years, over $300 billion on AI infrastructure. The revenue from all their AI products combined is maybe $60 to $80 billion annually. But even that is generous. Most of that is optimization revenue making existing search, ads, and cloud services slightly better. The new money, the standalone AI products that this whole bubble is based on, ChatGPT subscriptions, Copilot fees, that revenue stream is, at best, $10 to $15 billion. Do the math. $300 billion in spending, generating $10 to $15 billion in new revenue. That is a 0 to 1 spending to revenue ratio. You would need 20 years of that revenue just to pay back the hardware. In technology, 20 years is not a business plan. It is an archaeological era. The entire landscape will have changed 3 times over. But it gets worse. This entire house of cards is built on one single assumption, that the revenue, while small, is growing exponentially, that it will catch up. What if it doesn't? What if the growth stops? What if the revenue we see now is all there is? There are signs this is exactly what is happening. To understand this, we must move from the balance sheets to the human element. We must talk about the use cases. Why? Because AI is a solution, but it may be a solution to a problem that is far smaller and far less valuable than its investors have been promised. The technology is, without question, impressive. It can write text, generate images from thought, analyze data, write its own code. These are real, almost magical capabilities. But the cold, hard question of every economy is not, is it impressive? It is, will someone pay for it? And more importantly, will they pay enough to cover the cost? Right now, the answer to that second question is a definitive no. The market has set a price for this magic, and that price is $10 to $20 a month. ChatGPT Plus is $20. Google's AI Premium is $20. Microsoft's Copilot is $30. These are consumer prices. They are the price of a streaming service or a music subscription. but they are being used to pay for a technology with a cost structure that is closer to building a nuclear reactor. To justify the hundreds of billions in infrastructure, you need hundreds of millions of paying subscribers. Let's look at the reality. As of late 2024, ChatGPT, the market leader, has about 10 million paying subscribers. At $20 a month, that is $2.4 billion per year in consumer revenue. Combined with enterprise customers, this gets OpenAI to its $3.5 billion total. But remember, they're losing over $2 billion a year. Even with 10 million dedicated fans, they are drowning in compute costs. To become profitable, OpenAI faces an impossible choice. 1. Raise prices dramatically, which would cause their 10 million subscribers to evaporate. Or 2. Reduce their costs dramatically, which requires a breakthrough in efficiency that no one has yet discovered. Neither is guaranteed. Both are unlikely. What about the others? Microsoft's Copilot has fewer than 5 million paying users. That's $1.8 billion per year against a $60 billion investment. Google's AI Premium has even fewer, maybe 2 million subscribers, a rounding error. These numbers are not enough. They are not remotely enough to justify the spending. And here's the most dangerous signal of all. The growth is slowing. The initial surge, the wave of global curiosity that saw 100 million users sign up in 2 months, has passed. The frenzy has subsided. ChatGPT's subscriber growth has plateaued. It has reached a steady state. New users signing up are now roughly equal to the number of users canceling. This is the classic pattern of a product that has found its market. The only problem is that the market is a fraction of the size that the $10 trillion bet required. But what about the enterprise? What about corporations? Adoption here is also slow, not because the tech doesn't work, but because integrating it is expensive, complicated, and fraught with risk. You must manage data privacy, train employees, and re-engineer entire workflows. And for what? Companies are discovering that AI improves productivity marginally, not revolutionarily. A recent MIT study on a tool like GitHub Copilot found it improved programmer productivity by about 26%. 26% is good. It is a solid win. But it is not transformational. It is not the 10x revolution that was promised. It does not justify burning $400 billion a year on new data centers. This is the revenue side of the equation, a small, niche, high-cost market. Now, we must look at the other side of the ledger, the side that everyone is trying to ignore. The costs, because this is where the bubble's logic truly and terrifyingly breaks down. Running AI is expensive, not new software expensive. It is new infrastructure expensive. It is absurdly, fundamentally expensive. Training a large language model like GPT-4 is estimated to cost over $100 million. That is just the initial cost, the birth of the model. The real silent killer is inference. That is the cost of running the model to answer a user's query. Every time you ask ChatGPT a question, every time you generate an image, it costs OpenAI money. Estimates are that each query costs between 1 and 4 cents. This sounds like nothing, a fraction of a penny, but we are in a business of billions. If ChatGPT handles 10 billion queries per month at 1 cent each, that is $100 million per month. If the queries are complex, at 4 cents, that is $400 million per month. That is $1.2 to $5 billion per year. Just for inference, just to answer the questions. And these costs are not decreasing. Yes, Nvidia's new chips are more efficient. Software is being optimized, but these small gains are being erased by the models themselves. As models get bigger and more capable, the costs increase. GPT-5, whenever it arrives, will cost more to train and run than GPT-4. Google's Gemini Ultra costs more than Gemini Pro. This creates a trap, a fatal competitive doom loop. To compete, you must release bigger, better models. But bigger, better models cost more, so you must spend more. And unless your revenue increases faster than your costs, you are in an economic death spiral. OpenAI is in this trap right now. They must release better models to justify their $150 billion valuation and stay ahead of Google. But those better models will cost them more. And their revenue is already failing to cover the models they have. This is the internal, logical failure of the AI economy. But there is an external cost, a physical one, that is even more unsustainable. A cost that could bring this entire industry to a halt. Energy. Let us talk about energy. Because the AI revolution does not run on code, it runs on power. Raw, brute force electricity, consumed at a scale we are only beginning to comprehend. Training a single large model, like GPT-4, consumed an estimated 50 gigawatt hours of electricity. That is enough energy to power 5,000 American homes for an entire year. For one model, one training run. And in this new arms race, companies are training dozens of these models, many in secret. But training is just the birth. The real cost is keeping the intelligence alive. Inference, answering our queries. A single Nvidia H100 chip, the workhorse of this revolution, draws 700 watts at full load. This is not a laptop. This is a high-powered oven, and it is running always. Now, scale that. A modest AI facility, a cluster of 10,000 of these chips, draws 7 megawatts of power, continuously. That is the same power draw as a small town or a small industrial power plant. But the giants, Microsoft, Google, Meta, are not building modest clusters. They are building facilities with 50,000, 100,000 chips. These new digital brains draw 35 to 70 megawatts, 24 hours a day, 7 days a week. Let us translate this into the language of money. At commercial electricity rates, a single 70 megawatt facility costs between $50 and $100 million per year in electricity alone. That is before you add the cooling. The massive, energy-intensive systems required to stop this silicon from melting itself, that adds another 30 to 50%. So, a single, large AI data center can cost up to $150 million every year, just to keep the lights on and the temperature down. And again, they are building dozens of these. It is a new, invisible global infrastructure, built on a power draw that rivals entire nations. The total energy consumption of AI is on a trajectory to exceed that of entire countries. By 2027, at this rate, AI data centers could consume more electricity than all of Argentina, more than Sweden. This is the physical, brittle breaking point. Our power grids, relics of the 20th century, cannot expand fast enough. The environmental impact, in an era defined by the climate crisis, is being willfully, quietly ignored, all in the name of hype. This is the internal, logical failure, the physical, unsustainable cost. But where does all this delusion, this denial of physics and finance, become visible? Where does this collective mania take form, priced by the second? It is in the one place where belief is traded as a commodity, the stock market. This is where the bubble is at its most transparent and its most dangerous. Let us look at Nvidia. Its stock price has become a cultural artifact. From $150 in early 2023 to over $900 by late 2024, a six-fold increase in less than 2 years. Nvidia's market capitalization now stands at over $3 trillion. It is one of the most valuable companies in the history of the world. But here is the problem. Nvidia's valuation is not based on what it has earned. It is based on a single fragile assumption that this level of AI spending, this $400 billion a year inferno, will continue or even increase forever. The moment that spending slows, the moment a single tech giant flinches and cuts its chip order, Nvidia's revenue collapses, and its stock price follows. Look at the fundamentals. Nvidia's price-to-earnings ratio, the classic measure of value, is hovering around 65. This means investors are paying $65 for every $1 of Nvidia's current annual profit. Historically, a P/E ratio over 25 is considered expensive. Over 50 is bubble territory. Nvidia, at 65, is priced for perfection. It is priced for a future that has no room for error, no room for a slowdown, no room for reality. Any disappointment, any sign that the AI gold rush is easing, and the stock does not correct, it crashes. And the slowdown is not just coming, it is inevitable, because the companies writing those $400 billion checks cannot keep doing it. Eventually, the spreadsheet must be balanced. Eventually, they must show a return on that $300 billion spent, and when they cannot, the spending stops. We are already seeing the first tremors. In late 2024, the first wave of AI startups began to run out of money. Companies that raised hundreds of millions in 2022 and 2023 burned through it all. Not on products, not on marketing, but on compute, on renting the very chips that made Nvidia a titan. Now, they are trying to raise more money. And for the first time, investors are asking the hard questions. What is your revenue? What is your path to profitability? When do you break even? And for many, there is no answer. The money is slowing, not stopping, but slowing. The parallels to the past are not just disturbing, they are identical. Let us talk about the year 1999. The narrative was intoxicating. We were promised a new economy, an age where the old rules of profit and loss no longer applied. Valuation was based on eyeballs, traffic, market share. Any company, as long as it had a .com at the end of its name, was minted with a billion-dollar valuation. Overnight, we saw titans emerge. Pets.com, Webvan.etoys, dozens of companies with no profits, no viable business model, and valuations that dwarfed 100-year-old industrial giants. The Nasdaq index, the altar of this new faith, hit 5,000 inches March of 2000. Then, the reckoning. By October 2002, the index had fallen to 1,100, a 78% decline. $3 trillion in market value vanished, gone. The companies that survived, Amazon, Google, eBay, were the ones that, even in the midst of the mania, were quietly, painfully building real business models. They were focused on a path to profitability. The ones that died had neither. They had traffic, they had users, they had hype, but they had no money coming in. AI, in 2024, is the ghost of 1,999. The technology is real, just as the internet was real. But the valuations are based on the exact same set of flawed assumptions. In 1999, investors assumed every internet company would eventually become profitable. Most did not. In 2024, investors assume every AI company will find a massive, untapped market. Most will not. The technology works, but the market size is far smaller than the hype, and the costs are far higher than anyone was willing to admit. Let me give you a specific modern parable. A company called Inflection AI. It was founded by a co-founder of DeepMind, Mustafa Suleyman. It had the perfect pedigree. It raised $1.3 billion. It built a chatbot called Pi. And Pi was fine, it was good, it worked well, but nobody paid for it. It was free. In 2024, after burning through hundreds of millions of dollars on compute and talent, the story ended, not with a bang, but with a whisper. Microsoft, an investor, essentially acqui-hired the entire team. They paid Inflection $650 million. Not for the company, but for access to its models and, more importantly, to hire Suleyman, Inflection's investors, who had poured in $1.3 billion. Got some of their money back, but the company, as a viable entity, evaporated. This is the pattern. A company raises billions. It spends those billions, not on building a business, but on compute, paying Nvidia and Microsoft. It fails to find a revenue stream to cover those astronomical costs. And it is either absorbed for parts by the very giants it was paying, or it simply shuts down. This is the fate that awaits 90% of the AI startups you see today. Their failure is already written into the code. Now, let us talk about what happens when this bubble, this $10 trillion cognitive dissonance, finally pops. Because it will pop. History is clear. The only question is when. And history also shows us the three catalysts, the three triggers for a systemic collapse. First, a major company fails. In 2008, it was Lehman Brothers. In 2000, it was the cascade of dot-com bankruptcies. When a major, visible player goes to zero, it shatters the illusion. Panic becomes rational. Everyone realizes, at the same moment, that the emperor has no clothes. For AI, this could be a too-big-to-fail AI startup, one of the unicorns burning through its billions and shutting its doors. Or it could be a big tech company, like Microsoft or Google, taking a massive write-off, admitting that tens of billions of dollars in AI investments are now worthless. The second trigger, revenue growth stops, when investors are forced to see that the promised exponential growth isn't happening. They sell. This happened with crypto in 2022. The market finally realized mainstream adoption wasn't coming. For AI, this will be the quarterly report. The moment ChatGPT's subscriber numbers are visibly, undeniably flat. The moment Microsoft is forced to admit that Copilot revenue is not meeting expectations. The moment Google admits Gemini is not generating any significant new income. These admissions will come, And when they do, the entire valuation model for the industry breaks. Third, and finally, costs become unsustainable. The most simple, brutal, and physical of the three. When companies simply cannot afford to keep spending $400 billion a year, they cut. And when they cut, the entire ecosystem seizes. Nvidia's revenue, built on this spending, drops off a cliff. Data center construction halts. Layoffs begin. This creates a doom loop. Less spending means less revenue for Nvidia. Its stock falls. Its market cap shrinks. It must cut its spending. The contraction accelerates, feeding on itself. We are not there yet, but we are closer than most people are willing to believe. So, what will this crash look like? When the logic of unsustainable costs finally meets the reality of insufficient revenue, this is what happens. Nvidia's stock will be the first to fall. It is the most overvalued and the most purely dependent on continued frenzied AI spending. When that spending slows even 20%, Nvidia's revenue contracts, and its stock crashes. I am predicting a 50 to 70% decline from its peak. A fall from $900 to $300 or less. This alone will wipe out $2 trillion in perceived market value. The big tech companies, Microsoft, Google, Meta, Amazon, they will decline, but less severely. A 20 to 40% drop. They will survive. They have other, real, profitable businesses. But their AI divisions will be decimated by massive write-offs, tens of billions in impaired assets, data centers that are no longer revolutionary, just expensive, empty warehouses. And the AI startups? They will crash the hardest. 90% will fail, only the ones with real revenue, and a clear, tangible, boring path to profitability will survive. The rest? They run out of money, they shut down, billions in venture capital vaporized. This sounds dramatic, but it is not. It is exactly what happened in 2000. Trillions vanished, hundreds of companies failed, and the industry consolidated, painfully, around a few winners. The same will happen with AI. A few companies, maybe OpenAI, if they can somehow find a path to profit, maybe Anthropic, will survive. Google and Microsoft will survive, wounded but intact. But the hundreds, thousands of AI startups building chatbots, image generators, and coding tools, they will disappear. Now, I must address the counter-argument, the argument of the true believer. Maybe you are wrong, they say. Maybe the scale of this is different. Maybe AI will find massive, new revenue sources. Maybe businesses will start paying billions for these services. Maybe consumer adoption will explode and every human on Earth will subscribe to 5 different AI models. It is possible, but it is not probable. And here is why. The use cases, as we see them, are broad, but they are not deep. AI can write an email. It can generate an image. It can summarize a document. It can write code. But once you have one AI that does these things well, why do you need 5? You do not. This is not like streaming, where one service has different movies than another. This is a utility. It is like search. The market for search engines did not end up with 20 different profitable companies. It consolidated brutally around one winner who took 90% of the market. The market for AI will do the same. It will consolidate around 1 or 2 good enough winners. The rest will get nothing. The enterprise use case has the same fatal flaw. Most companies do not need a custom-built $100 million AI model. They just need their existing software to be a little smarter. This is not a product revenue stream. It is a services revenue stream. You cannot sell integration to millions of businesses with zero marginal cost. Each integration requires custom work, human consultants, and endless meetings. This is a good business for a company like IBM or Accenture. It is not a scalable, high-growth, high-margin software business. It cannot justify the $400 billion a year infrastructure spend. Then comes the second counter-argument, the technological one. Costs will get cheaper. This is the hope of Moore's law. The idea that compute, over time, always, magically, gets cheaper and more efficient. So maybe the costs drop and the entire business model suddenly becomes profitable. This is possible, but it is not happening. And it is not happening for 2 reasons. First, it is not happening fast enough. Yes, Nvidia's new Blackwell chips are more efficient than the old H100S, but they also cost more. The net cost reduction per query is maybe 20–30%. That helps. But it does not solve a problem where your costs are 20 times your revenue. It is a rounding error. Second, every gain in efficiency is immediately consumed by the models themselves. This is the Red Queen race. To compete, you must build bigger models. GPT-5 must be bigger than GPT-4, and that bigger model, even when run on the new, more efficient chip, ends up costing more to run. The technology is in a race against itself, and its costs are winning. This leads us to the final counter-argument, the last-ditch defense of the bubble. The argument is AGI, artificial general intelligence. This is the idea that AI will not just be a tool, but will become a true mind, a digital intelligence that can do anything a human can do, intellectually. If that happens, the believers say, the revenue potential is infinite. Every knowledge worker, every office job is replaced. That is trillions of dollars in labor costs that could be captured, theoretically, as AI revenue. There are two fundamental problems with this. First, and most practically, we are not close to AGI. Despite the breathless hype, current AI is narrow. It is a powerful statistical engine. It is a parrot, not a mind. It cannot reason. It cannot plan long term. It has no true understanding of the context it is processing. AGI might be 10 years away. It might be 50. It might be impossible. And you cannot, and must not, base a $10 trillion investment on a technology that may not arrive for decades, if ever. That is not investing. It is a lottery ticket. Second, and this is the deep, dark paradox of AGI, even if it does come, the economic model is not just unclear, it is self-defeating. If AI can do all knowledge work, who pays for it? If it replaces all the workers, those workers no longer have an income. If they have no income, they cannot buy the products and services that the AI is now producing. The economy does not boom, it contracts. This is the automation paradox. A technology that eliminates all jobs, by definition, destroys its own market. So, AGI, if it arrives, is not the revenue bonanza investors are hoping for. It is an economic crisis. It is a sociological and political event that will require a fundamental restructuring of how our entire society works. It is not a subscription model. So, if the revenue is not there, if the costs are unsustainable, and if the miracle of AGI is a financial paradox, we are left with the cold, simple reality of a bubble. The question then becomes, not if it will pop, but when, and what you should do as you stand in the shadow of this $10 trillion machine. Now, we must ask the final question, what should you do? Many people are now invested in this bubble, whether they know it or not, directly through a stock like Nvidia, or indirectly through an index fund that is now dominated by these few super overvalued tech giants. My analysis, which is not financial advice, but simply an analysis of this historical pattern, is that these AI stocks are fundamentally, dangerously overvalued and are due for a severe correction. If you own Nvidia above $700, you are at significant risk. You are not holding an investment, you are holding a belief. If you bought at $200 or $300, you have seen massive, life-changing gains. The rational move is to lock them in, to convert the abstract, digital value on your screen back into the real, physical world. Because when the correction comes, it will be fast and it will be brutal. If you own the big tech giants, Microsoft, Google, Amazon, you are safer, but you are not safe. These companies are diversified. They will survive the crash, but their valuations will compress. A 20 to 40% decline is realistic as their multi-billion-dollar AI divisions are marked down to zero. And if you are invested in AI startups, through venture funds or private deals, you must understand what you are holding. These are not investments, they are lottery tickets. The 90% failure risk is real. Some may pay off. Most will go to zero. For most people, the best move is not to panic, but to be prudent, to reduce exposure, to diversify. Do not try to time the absolute top. That is a fool's game. But do not ride this all the way down out of sheer belief. The bubble is now obvious. The smart money begins to de-risk, to rebalance, and to wait. Because when the crash comes, after the fire, there will be extraordinary opportunities. The chance to buy the survivors, the companies with real, sustainable businesses at reasonable, rational prices. But that opportunity comes after the decline, not before. So here is my prediction for the timeline. In 2025, AI spending continues, but the growth slows. Instead of increasing 50% year over year, it increases 20%. This, for a market priced for perfection, is a profound disappointment. The stocks begin to decline, the cracks appear. By mid-2026, the major companies are forced to report the truth. AI revenue is not meeting projections. The great write-offs begin. Tens of billions in impaired assets are announced. Nvidia's stock, at this point, has declined 40 to 50% from its peak. By 2027, the bubble has clearly popped. This is the trough. AI startups are failing en masse. The hype has turned to disillusionment. The word AI becomes, for a time, toxic. The industry is consolidating painfully around the few who built on reality. By 2028 or 2029, AI stabilizes. The survivors have real businesses. Their revenue is growing steadily. Profitability exists. The technology is being integrated into the economy at a sustainable level. But the total market value is a fraction of what it was at the peak. Instead of 10 trillion, maybe 2 trillion, $8 trillion vanished. This is the normal pattern. The technology, the real technology, is not the thing that is valuable in a bubble. It is the hype. And the crash is simply the moment the hype is wiped out and the excess is cleansed. The technology is real and valuable, but the initial hype, the collective mania, is always 10 times what the actual market can support. The crash does not kill the technology. It just kills the impossible expectations. The survivors rebuild on realistic foundations. And in 10 or 20 years, the technology is everywhere. But it is boring. It is infrastructure. That is what will happen to AI. It doesn't disappear. It becomes part of the background. Like the internet, like databases, like cloud computing, it will be essential, but it will not be magic. And its valuation will reflect its utility, not its hype. $10 trillion invested, maybe 60 to 80 billion in revenue. The math doesn't work. The costs are too high. The revenue is too low. The use cases are more limited than promised. This is a bubble, not because AI is fake, but because the expectations we have placed on it are impossible. And when impossible expectations meet economic reality, reality always wins. The crash is coming. The only question is whether you will see it before it happens.